Hello and welcome. You're watching KYC. I'm Harsh Saita. Today we're going to focus in on Neogen Chemicals. This is what I want to know about the company, and there's plenty of moving parts, and we'll focus on each one of them. First one is with regard to the existing business. I want to know whether the Dahej facility comes back and comes on stream quickly. How quickly should the drag from the Dahej facility normalize, and how quickly should the top line recover with regard to the existing business? This is of course on the existing business. Now let's talk about FY26 and FY27 numbers therefore. How should the existing business numbers look from FY26 and 27? Because we've seen very low to no growth from FY23 all the way up to FY25. So it's been 3 years where on the existing business we haven't seen growth because of various reasons. How quickly should that normalize? How quickly should that unwind? Really, that's the other core piece I want to understand. Electrolytes business. Now this is the new business. What are the growth expectations here? What are the risks? What are the margins? Is this a commoditized business or not? Really, that's the other piece which I'm worried about. Is pricing eventually, when multiple players come in, is pricing power going to go away, or is it going to be held by the company? Because if you are valued at 94, 95 times, then you want to know whether you will continue to have pricing power over the top line that you are expecting to grow by. Let's also talk about the investment in this business. Around 1500 crore or so to be funded. Around 500 crore of that funding has already happened. Around another fresh 1000 crore to be invested. How will that investment be funded? Because your debt to equity is already quite steep. So are you going to take on more debt is really my question. And last off, can return ratios normalize? Because we've seen return ratios fall quite sharply. And it will require these couple of levers for it to normalize. But what's the confidence that return ratios can go back maybe as high as 20% as they were a few years back, or maybe 4 or 5 years back? That's really the question I want to answer. But that's how it all stacks up in what I want to know about Neogen. Let me also quickly look at what the company does. And Neogen Chemicals currently manufactures bromine and lithium-based organic compounds. This is what it currently manufactures. Specialized to a certain extent, not too many people can do this because it's very specialized, but Neogen in that sense is valued or given a higher multiple because of that specialization. So that's one. Second, compounds, where are they used? They're used in pharma, agri-chemicals, as well as engineering industries. So those are the 3 places where it's used. It manufactures advanced intermediates in pharma, agro, flavors and fragrances. It's the largest importer of lithium carbonate and lithium hydroxide for the last 3 decades. So it's built a bit of a niche with regard to some of these products. Let's talk business segments. The first segment that we'll talk about is organic chemicals. Bromine compounds and advanced intermediates. Now, advanced intermediates are if I can describe it in the most layman terms, is between a key starting material and an API, closer to an API, and therefore an active pharmaceutical ingredient, which basically finds the cure to the disease that you're suffering from, whether it's a cough, whether it's a cold. The API is what finds the cure. Advanced intermediaries are also a compound or a component which allows you to build an API. So it's not a key starting material, but it's not an API either. That's how advanced intermediaries is. Bromine compounds, of course, are bromine based. Also into custom synthesis, contract manufacturing, when products are developed for specific customers. This is obviously the low-hanging fruit which everyone is now latching on to, and Neogen is no different. Let's talk about the inorganic chemicals. They are into specialty inorganic, lithium-based chemical products. So all of those, they are also into applications in the organic chemical space. What are the applications like? They are applied in pharma, agrochem, flavors, fragrances, I'm just repeating this, electronic chemicals and semiconductors. We can roll forward to the next slide. That kind of shows where all the applications is for some of the organic chemicals. These are the clientele of Neogen. So if you see the kind of clientele they have, very, very solid, right? In that sense, no concern whatsoever. Let's look at the revenue mix between organic and inorganic, currently sitting at 84% organic to just 16% inorganic. The geographical split, domestic is around 63%, exports is around 37%. This is 9-month FY25. And you're looking at the company exporting to over 29 countries, US, Europe, Japan, China, Korea, and the Middle East, among some of them, along with having all of those clients in India. So definitely the potential is quite large, but you want to see it live up to the potential. So let's look at some of the metrics that we look at in terms of financials. Now that we've got some bit of a grip on the business, let's look at all the factors that we look for with regard to a Neogen. First, we look at the income statement, we look at the balance sheet, we look at the cash flow, we look at return ratios. Thereafter, we look at shareholding, street cred. We'll also look at street coverage, and we look at valuation. So that's how we'll stack up our rating parameters. Let me quickly start with the income statement. When you're looking at the income statement, you're not seeing significant growth on the top line. There you go. No significant growth in the last 3 years on the top line, even though it's done well prior to that, but you're not seeing that significant growth kick in. EBITDA as well, your margins have gotten marginally better in FY25, but those will be impacted by raw material costs, and therefore they will be slightly, or rather moving in that band between 16 and 20 is the sense. Look at the profitability also, it's come off from the slightly higher number that we saw in FY23. It's a very, very average looking income statement for the moment, but plenty of levers, the Dahej facility being the key. That's the reason why there's been a revenue drag in FY25 and a profit drag and an EBITDA drag. So you're seeing some of these numbers in that context. Also understand profitability is impacted because of higher debt. Your interest cost has gone up substantially due to the capex that they're doing, and therefore you'll likely see profitability remain subdued, maybe for another year or so before it starts to really pick up. So that's the other piece you want to look at. The second metric is the balance sheet. Now, when you're looking at equity and reserves, it's largely steady state, but when you look at the borrowing, it's gone up from 400 crore to 600 crore in just about a year. This is what I'm talking about. The borrowing number has gone up, which is leaving the company exposed to a certain extent to higher interest cost, but also servicing or repaying this borrowing at some point. You saw the EBITDA number being just above around 100 crore odd. The cash flow, in fact, was even lower in that sense, and therefore that's something you want to look out for. But overall, what you're seeing here is that the ability to repay is becoming more and more difficult, but you have an expansion in the top line, which is in the pipeline, and a strong expansion, which could well aid the numbers from FY26 and FY27 onwards, which could make this look far better. So we want to wait for that. At least that's what the street seems to be suggesting. Mind you, on the P&L again, top line is expected to expand 5x by FY29 as per average analyst estimates on Bloomberg. So you're expecting a 4 to 5x expansion in the top line. Just try and understand how much that would aid the overall set of numbers. Maybe not a 4 to 5x, I beg your pardon. It's probably 3 to 4x in terms of top line expansion. The bottom line was expanding, the EPS was expanding by nearly 5x, 4 to 5x. So you'll see that very strong expansion come through, which could aid that borrowing number on the balance sheet, which we'll have to wait and watch out for. Can that really happen? Now let's talk about cash flow. Cash flows have gone up in this quarter, in this year. It's because of some adjustments in working capital which have happened. But outside of that, the cash flow remains subdued. It remains in a difficult spot, and that is again because of the fact that there's no expansion coming through and there are higher interest costs which are coming through. We'll give this a neutral as well, and we'll wait and watch as to how cash flow evolves. Let's talk about the shareholding pattern at this point. 51% promoter held, definitely a positive because a decent amount of skin in the game. there's a decent amount of FII and DII participation to the tune of nearly 30%. So your capital, your free float is just about, or rather public holding is just about 18 odd percent. So we'll give it a thumbs up on this one. Let's look at street cred. Again, the last 1 year, the stock has done just 7%, but the last 6 months and the year-to-date period, it's done far better. We'll again give this a thumbs up as well. I want to look also at return ratios because that's the other key component. And it gives you a lens into how the investments made by the company are playing out. At the moment, we're not seeing that happen. You look at it from 25% in FY20, the return ratios have steadily come off. It's 6%, is probably bottoming in FY25. The guess is that it will start to pick up starting FY26. So your return on equity, return on capital employed, this is the trend which is playing out. We're giving this a definitive thumbs down. You want to wait and watch whether and how quickly do those return ratios go towards 20. The Bloomberg estimates suggest that it will take all the way to FY28 or FY29 for it to hit 20% again. But it's going to be a slow uptrend starting FY26. That's the indication that analysts seem to be suggesting. And I keep coming back to analysts because we also have to take the analyst ratings. Let's take that before we look at valuations. In terms of how analysts are viewing this, there are 8 buy calls and just 1 hold call. The upside is 40% from here. And valuations don't look cheap though. It's a thumbs up because analysts are super positive. But you look at valuations, and when you're looking at valuations, it's trading at 95 times nearly price to earnings. And I'm talking about trailing 12 months. The forward-looking piece is very different. When you're looking at it from a forward-looking perspective, valuations, your profit after tax in FY29 is penciling in 300 crore of PAT. Now, for a 4,000 crore market cap company, that's 13 times. So very strong growth being penciled in. From that 95 times, can it come down to 13 times in the next 3, 4, 5 years is really the question that we will hopefully get an understanding from management from. The valuation picture, therefore, is a neutral because while it's 93 times currently, you could well see a sharp reversal in that number going forward. Let's not delay this further. Let's move straight to the management. We spoke to Dr. Harin Kanani, who is the managing director at Neogen Chemicals earlier today about the company's growth prospects to start off with on the existing business. Let me cut straight across to that question which he answered.
So, this bromine derivatives business, or what we call the base business, has bromine derivatives, advanced intermediate, our CSM business, our recently acquired organolithium, and the non-battery lithium compounds together. So the capacity that we have is something which is for 1,000 crores. And our initial target also for this year was around 950 to 1,000 crore. We had a little bit of a setback because of a fire incident in one of the units in Dahej.
Correct.
So currently this year we are focused on a revenue potential, what we have guided 775 to 850 crores. So it will be about 10% kind of increase over last year's performance. However, the capacity is there, and it's largely because Dahej plant MPP3 is currently being rebuilt. As soon as that is rebuilt for the next year, our guidance for that would be a 1,100 crore plus kind of a revenue. So for this year, approximately around 800, 850 crore. And let's say next year, we are looking at somewhere around 1,000 to 1,100 crore. Of course, this is mainly because, as you can see, that in spite of soft international market, this base business already grew at a 13% kind of a rate last year. And had fire incident not been there, it would have been somewhere close to around 17, 18%, and a volume growth upwards of 20%. So the demand is really looking good. Unfortunately, we had a little bit setback on the capacity. But I think once the new plant is rebuilt, which we are taking a lot of additional cares, and it is again going to be, this was one of our state-of-the-art plants, and the one which is getting built is even better. So once that comes online, next year, we are looking for a very great further significant increase to meet several customer demands.
Point taken. So, sir, for clarity of viewers, 800 to 850 crore FY26
and then
Yes.
1000 to 1100 crore FY27. So the base business itself will add 50% in terms of top line over the next couple of years. So I want to therefore talk about margins. What's working at this point? Are these high teen margins sustainable for the base business first?
So for the base business, we have always been like, ever since we acquired our plant in Baroda, which gave us some leverage, like both on the scale as well as in terms of being able to handle bulk bromine. And then subsequently, we got into more complicated CSM business or now organolithium. So we have sustained like 17% to 18% kind of margins, 18, basically 18, 18 and a half, plus or minus 1.5%. Sometimes it's a little bit lower or sometimes a little bit higher, partly due to lower raw material price because our per ton margins more or less is kind of what we can achieve. But sometimes when the lithium price is too low, it go as a percentage it goes higher. Of the lithium price goes very high, it goes a little bit low. So again, that low range is also between 16 to 20%. If you look at like almost last 8-9 years history. So I think we can sustain that. And once we reach the full utilization, as the organolithium and the CSM business contributes more and more to our business, going forward, the target would be move closer to 20% and beyond. Again, this is only possible through innovation. So we have a lot of innovative products and also technologies which we are developing. So long-term target would be to go there. But for now, this business has already sustained 18% plus minus 1.5% kind of margins for last 7-8 years, and we look forward to being able to do that.
Point taken, sir. So roughly, if I were to just compute EBITDA, that would be roughly in the range of maybe 130 to 170 odd crore, 180 odd crore over maybe the next year or two. Is that a fair assessment?
Yes, I think this year itself was 130 crore plus.
Correct.
So I think
Yes.
you would as we get higher top line, you would see that. Of course, there will be some additional expenses in this year as we are rebuilding because of fire. So on a quarter, you might not get that. Although we have a loss on profit, but depending on how the accounting treatment takes care of that. So there might be some mismatch on a quarter-to-quarter basis kind of a thing. But let's say if we are talking of next year, when we are thinking of a full utilization of 1,000 crore plus kind of revenue potential, we would basically look at 170, 180 or slightly higher EBITDA coming in from Neogen's base business.
Point taken, sir. So I want to now focus on the electrolytes business because that's where all the interesting things are happening, right? So talk to us first off about what the capex is going to look like. What's the outlook like in terms of how much is this business going to contribute to top line over FY26 and FY27? So the same questions for the base business which I asked you, I'm asking you for the electrolytes business.
Yeah, so before I get into that, I would like to say, at least Neogen's point of view, that for us, the organolithium acquisition or getting opportunity to do something in semiconductor in last 2 years is equally exciting. So inside Neogen, we don't have a partiality only for battery business. Although yes, I agree with you that a lot of investment and efforts are being put there. So here we have planned over 2 years. We had planned around 1,500 crores of capex. This was divided in two parts. That some smaller capacity which can support 3 giga, 5 giga worth of electrolyte and salts, let's say up to around 12 to 15 gigawatt hour. So these capacities were coming in our existing Dahej site. So a part of the Dahej site which was converted to Neogen Ionics, the wholly owned subsidiary, and the major capex was coming into a greenfield site in our Pakhajan. Between two, we are investing around 1,500 crore, of which 550 crores is already come, already around 450 to 500 crore is already invested by us, and the rest will be invested in the current financial year. We already have a running electrolyte facility which can give 2 gigawatt hour plus. Already the salt facility, also electrolyte salt facility, is also partly commissioned and partly in trial production and getting ramped up. So based on the capacities which are coming, and the Pakhajan facility is likely to come online in Q4 of the current financial year. So based on these capacities which are coming online, we have given a revenue guidance of around 300 to 500 crores revenue on the electrolyte and electrolyte salt business in the current financial year. And for the next financial year, when we'll have the Pakhajan facility fully available, we don't have a number yet, but the estimate is it will be something more than 1,000 crore. But how much more is something which we've not given a formal guidance, but that is just the base expectation, because the total capacity on full utilization can give us 2,500 to 3,000 crores kind of revenue, and the full utilization is expected by FY28, FY29. So we expect that by FY27 we will be at least 1,000 crore plus, basically more than kind of 50% kind of utilization of the facility we are installing. But the exact number we have not yet given, so it's not a formal guidance, just kind of an estimate for next year.
Sure, so point taken, soft guidance.
Yeah.
Sure.
And this is basically driven by two factors. One is the electrolyte demand and international salt. So international electrolyte demand in India to some extent depends on the battery capacity being set up. So we know around 6 to 7 gigafactories are announced, which are starting in 2025 or 26. So we are discussing with all of them, and little bit to some extent the demand will depend upon how these capacities come online and how their demand comes. On the salt side, we have international customers where we have a tie-up for majority of the salt which we are going to produce. There, of course, it's a very lengthy approval process. So it will be subject to, how the approval process plays out. So these are the two main factors which create the variability. And of course, lithium price is another thing which basically affects the top line. But basically the EBITDA would be driven by like ROCs, depending on investment. So on the full utilization, we are targeting like a 20% ROC. So it will be depending on.
Okay, so super detailed, and I have too many questions on this, but I'll break it up. I'll first talk about pricing here, sir. How much of pricing is in your control? How commoditized is this business in your opinion? Because it's a new business, not too many people doing it. Is it commoditized? And because there are too many players interested in it as well.
So, first of all, so we are basically, so on pricing, right? There are two aspects of the pricing. One aspect is basically the lithium and other input price. So if we think of like, electrolyte. So electrolyte doesn't have just lithium salt, but like, when you make lithium salt, along with lithium, you have fluorine, phosphorus, you have solvents, you have additives. So the electrolyte cost will depend on all the inputs, as well as like, our manufacturing costs, and then of course the operating margins that we are targeting. So what we have seen, that in this business, as you grow scale, so as you go from 10 giga to 100 giga to maybe 500 giga, you cannot expect like same levels of per absolute margin. So what we've seen is, when the volumes grow, so when volume becomes high, your absolute EBITDA per ton will change. But your incremental capex will be required less, and you'll have so many synergies which is coming in. So we've done a similar business, of course, not to this scale, but we were making lithium bromide for absorption chillers. So it's also a chemical company selling to kind of an engineering company, which is a different industry. And here also, we have started by making few lakh sale in 1985, and now, selling tens of crores, and together like getting close to around 100 crore kind of. So we've also seen like 3-4 orders of magnitude there. And I think what basically has worked is that most customers appreciate very transparent pricing. They don't expect you to make money on inputs. Yes, but they want you to control your costs, control your investments. So that is going to be our role, as experts who are doing that. So that's why we have said this is a ROC driven business, that as incremental return on capital will get reduced and the amount of internal capital will get reduced, the return on capital will be lesser required, and therefore your EBITDA might change. So I think EBITDA might not remain constant as we go from, let's say right now we are planning 30 giga, but when we are at 30 giga, EBITDA might be slightly different, but the ROC should remain constant. So it's a 20% ROC driven business. And at least so far, whenever we have discussed with our international customers, where we are actually, the international customer has a choice to buy either from China or Japan from India. And they appreciate this point, and we've been able to kind of get this. So the contracts or the pricing arrangements that we have in place is completely pass through, and which basically ensures that Neogen can earn 20% ROC as long as we can basically control the manufacturing costs that we have. So I think we should not be looking too much on like the top line exact number, or like the EBITDA percentage also, because they will change and fluctuate in this business. What we have to be that on a fully utilized basis, are we able to get the return on capital?
Okay, so that was a very interesting interview with the management of Neogen Chemicals. Uh, Growth expected to play out in a very strong fashion on this one. On the new business itself, 300 crore to 500 crore this year, which will take the top line from 800 crore or 770 odd crore to almost 1300 crore. And thereafter, you will see a scale up on the base business as well by at least 300 to 400 crore. So keep your eye out on it. Let's track progress. But for the moment, that's all that we have with regard to Neogen Chemicals. Interesting but tricky at the same time. Completely out of time on this edition of the show. Stay tuned to NDTV Profit. More action on the other side.